Look, Bitcoin just plunged below $60,000. It's a brutal 3.2% drop in a single day. Many thought that level was solid. But now, even billionaire investors are scratching their heads. Philippe Laffont, a titan in finance, openly admits he doesn't know what to think about Bitcoin anymore. That's a huge red flag for your money. Here's what's wild. This isn't just about Bitcoin. Gold and oil are tumbling too. Meanwhile, tech stocks are soaring to new highs. Nobody's talking about this shift enough. What does this mean for your portfolio right now? Your financial future could depend on understanding these moves. By the end of this video, you'll grasp why Bitcoin is losing its plot. You'll also learn where investor capital is actually flowing. And most importantly, you'll know how to protect your investments from this market chaos. Are your crypto holdings safe in this sudden downturn? Let me be direct. The crypto bear market continued in force. Bitcoin tumbled a shocking 3.2% on Wednesday. It fell back below that crucial $60,000 mark. Here's the thing. This wasn't an isolated event. Gold also lost ground, slipping below $4,000 per ounce. Oil followed suit, dropping below $70 per barrel. This is undermining the so-called debasement trade. That's a strategy favoring hard assets like gold and crypto. People were worried about government debt and fiat currencies. Fiat currencies are government-issued currencies not backed by a commodity. But that trade is unwinding. Now pay attention. While these traditional hard assets struggled, tech stocks rebounded. The AI boom continues to draw massive investor interest. Capital is pouring into artificial intelligence firms. South Korean memory chip giant SK Hynix is a prime example. On Wednesday, they filed to raise nearly $30 billion. This was a U.S. share offering. It's the largest overseas company capital raise since 2019. Saudi Aramco had a $26 billion sale then. The Nasdaq, heavily weighted towards tech, climbed 0.8% on Wednesday. This happened exactly as Bitcoin slumped. And get this, billionaire hedge fund manager Philippe Laffont summed up the sentiment. He told CNBC on Tuesday he's a little bit more worried about Bitcoin. Laffont stated, "I don't know what to think about Bitcoin anymore." He argues that companies like SpaceX and emerging AI firms offer clearer growth stories. These are easier to evaluate over long horizons. Plus, the rise of stablecoins has reduced Bitcoin's uniqueness. Stablecoins are cryptocurrencies designed to maintain a stable value. They've taken away some of Bitcoin's alternative financial asset appeal. Nobody's talking about this new line in the sand for Bitcoin. It's not $60,000 anymore. The market has found a new support level near $59,000. A support level is a price point. A downtrend often pauses there. It suggests strong buying interest. Bitcoin repeatedly bounced near $59,000 this month. On Wednesday, prices fell to nearly $59,000. They then bounced back to $61,000 overnight. A similar move happened on June 5th. Prices bounced from $59,000 to $67,000 then. So bulls must defend $59,000. Let me break this down. The focus on this support stems from Thursday's U.S. core PCE inflation report. PCE, or personal consumption expenditures, is the Fed's preferred inflation measure. It tracks consumer spending on goods and services. The core PCE excludes volatile food and energy costs. It's forecast to show the fastest price growth since late 2023. A hotter-than-expected reading could strengthen the dollar. This would send risk assets, including Bitcoin, even lower. May's combined exchange volumes fell 3.45% to $4.41 trillion. That's the lowest since September 2024. These aren't just numbers. They paint a clear picture. This historical to understand why we are seeing this current volatility, we have to look at the trajectory of the last few years. 5 years ago, we were in a completely different environment. Back in 2019, Bitcoin was largely viewed as a speculative outlier, but the narrative began to shift toward digital gold. By 2020 and 2021, we saw the massive institutional wave hit. We witnessed the price rocket toward that historic high of nearly $69,000 in November 2021, driven by a cocktail of pandemic-era stimulus and a sudden appetite for risk. The cause was simple. Cheap money flooded the system, and Bitcoin was the primary beneficiary of that liquidity. However, the tide turned sharply in 2022 when the Federal Reserve began its aggressive hiking cycle to fight inflation, leading to the infamous crypto winter where billions in market cap evaporated. Then, back in 2024, we saw a renewed surge of optimism. The approval of the spot Bitcoin ETFs in January 2024 changed the game, bringing in massive amounts of institutional capital and pushing the price back toward the $70,000 range. But that surge created a fragile equilibrium. The effect of this institutionalization is that Bitcoin is now more tightly coupled with traditional macroeconomic indicators than ever before. When the Fed hints at higher rates, or when inflation data like the PCE comes in hot, the reaction is instantaneous. We are no longer dealing with just retail traders on forums. We are dealing with algorithmic trading and hedge fund mandates. This is why we are seeing the current struggle. The market is wrestling with a fundamental identity crisis. Is it a hedge against government debt, or is it just another high-beta risk asset? When we see gold and oil falling alongside Bitcoin, it suggests that the debasement trade is unwinding. Investors who bought these assets to protect against a failing fiat system are now rotating that capital back into high-growth tech. The result is exactly what we are seeing now, a slide below $60,000 as the AI trade, led by giants like SK Hynix and their massive $30 billion capital raise, sucks the oxygen out of the room. The liquidity is moving from the decentralized dream of crypto into the tangible, revenue-generating power of artificial intelligence. When people say this is just another cycle, they are ignoring the structural shifts. If we look back at the 2018 crash or the 2022 collapse, the outcomes were similar in terms of price drops, but the catalysts were different. In 2018, it was the bursting of the ICO bubble. In 2022, it was the systemic failure of centralized lenders like FTX. Those were internal shocks. What we are seeing now is an external shift in investor preference. The similarity is the volatility and the fear, but the difference is the competition. In previous cycles, if you wanted a high-growth, asymmetric bet, Bitcoin was the only game in town. Now, as Philippe Laffont pointed out, the landscape has expanded. Investors can now bet on SpaceX or emerging AI firms that offer growth stories that are much easier to value over a long horizon. Furthermore, the rise of stablecoins has stripped away some of Bitcoin's uniqueness as the sole alternative financial asset. In the past, Bitcoin was the only exit ramp from the traditional system. Today, there are a dozen different ramps. We are seeing a genuine diversification of the risk-on trade. The same fear of inflation that drove the 2021 rally is still there, but the destination for that capital has shifted from a digital coin to silicon chips and neural networks. The psychological support levels, like the $59,000 mark we are watching today, are the new battlegrounds. It is a fight between the old guard of the debasement trade and the new guard of the AI revolution. This isn't just a dip. It is a reallocation of global wealth in real time. Now that we have the let's get into the hard data, because the price action alone doesn't tell the whole story. Here is what the data actually shows. We saw Bitcoin slip 3.2%, sliding below that psychologically critical $60,000 mark. While a 3% drop might seem like a standard Tuesday in crypto, let's weigh the two sides of this fight. The bull case relies on the $59,000 line in the sand. This level has repeatedly acted as a floor this month, bouncing prices back towards $61,000 and even $67,000 previously. For the bulls to win, we need to see the PCE data come in cooler than expected, which would weaken the dollar and give risk assets room to breathe. If Bitcoin can hold $59,000 and prove it is a strong support level, it sets the stage for a massive short squeeze. The argument here is that the current dip is just a healthy correction and a temporary rotation, and once the AI hype stabilizes, capital will flow back into the most liquid digital asset to diversify portfolios. On the other hand, the bear case is far more grim. The bears argue that Bitcoin has lost its uniqueness. With the rise of stablecoins and the explosive growth of companies like SpaceX and emerging neural network firms, the growth story for Bitcoin has become boring compared to the potential of AI. If the PCE report confirms that inflation is accelerating, we could see a deeper slide that breaks the $59,000 support. If that floor collapses, there is very little standing between us and a significant crash as the debasement trade completely unwinds. We could see a scenario where Bitcoin is no longer viewed as the primary alternative financial asset, leading to a prolonged period of stagnation or a crash toward the $50,000 range. The bear case isn't just about a price drop, it is about a loss of narrative. If the world decides that chips are the new gold, the demand for Bitcoin evaporates. So which side is right? That depends on what you do with this next. Now, let's talk about what all of this means for you and your hard-earned money. For the long-term investor, if your portfolio is heavily weighted in Bitcoin or other cryptocurrencies, these recent dips are more than just noise. A 3.2% drop below $60,000 on Bitcoin, coupled with gold falling below $4,000 per ounce, means the debasement trade that many of you relied on for diversification is actively unwinding. If you hold, say, $50,000 in Bitcoin, that 3.2% daily dip just wiped out over $1,600 from your net worth. And if it continues to erode towards that $50,000 range, you're looking at a significant percentage of your investment gone. This isn't just about the price, it's about the underlying narrative. If the market is truly shifting capital from hard assets to the AI boom, your long-term growth strategy needs a serious reevaluation to protect your future. For the short-term trader, this environment is a double-edged sword. The volatility creates opportunities, but the increasing uncertainty means higher risk. While a bounce from $59,000 to $61,000 might look like a quick win, the overall bearish pressure means your short positions on Bitcoin, if timed correctly, could be profitable. However, if you're trying to catch falling knives or are leveraged, a sudden breakdown of that $59,000 support level could trigger margin calls and liquidate your positions rapidly. Your income from active trading could see severe fluctuations, and a 3.2% daily drop could easily translate into a 15 to 20% loss of your trading capital on any given week if you're not managing risk tightly. This is not the time to be complacent with your stop losses. And for those of you with savings, perhaps not actively investing but watching the market for opportunities, this shift is equally critical. With gold struggling below $4,000 and oil below $70, the traditional safe havens are looking less secure. The core PCE report looming, potentially showing inflation above 4.1% year over year, means your cash sitting in a standard savings account is losing real purchasing power by the day. If the market truly believes that AI and tech are the future, and Bitcoin loses its unique appeal, then your options for protecting your savings from inflation become narrower and more complex. You need to consider how to preserve your capital in an environment where both traditional and alternative hedges are under pressure. So, what should you do in the next 90 days? Here's your now for the 3 specific indicators to watch closely in the coming 90 days. First, keep a laser focus on the Bitcoin price. If Bitcoin drops below $59,000 and fails to recover within 24 hours, that is your signal to tighten stop losses and reduce speculative positions. This level has proven to be a critical line in the sand. Second, monitor the core PCE inflation report. If the core PCE, which is the Fed's preferred measure, shows a year-over-year increase above 4.1% on Thursday, that is your signal to expect continued dollar strength and potential further pressure on all risk assets, including cryptocurrencies and commodities. A hotter-than-expected reading will reinforce the Fed's hawkish stance. Third, watch the Nasdaq Composite Index. If the Nasdaq continues to show strength, maintaining above its 50-day moving average, which is currently around 17,500 points, that is your signal that the AI trade remains dominant and capital flight from hard assets and less innovative alternatives could persist. These 3 data points will provide critical guidance for navigating the turbulent waters ahead. The big picture is coming up next, so don't go anywhere. Zooming out, what we're witnessing is more than just a rough patch for crypto. It's a profound repricing of risk across the entire global economy. This isn't just about Bitcoin. It's about the broader shift away from an era of abundant, cheap capital and into a new regime where liquidity is tighter and investors are demanding tangible value and immediate returns. We're firmly in a late-cycle environment where the easy money has been made and capital is becoming increasingly discerning. The market is struggling to reconcile persistent inflation with the need for continued growth, leading to a bifurcation where proven technologies, like those driving the AI boom, continue to attract significant investment, while more speculative assets, without a clear path to profitability or institutional adoption, face an uphill battle. This dynamic tells us that the market isn't just correcting, it's recalibrating its entire risk framework. Many are still clinging to the hope of a quick return to the frothy markets of yesteryear, but what you now understand is that we've entered a different paradigm. My bold prediction for the remainder of 2026 is this. Bitcoin will fail to reclaim its previous all-time highs this year, not due to a lack of innovation, but because institutional capital will remain firmly on the sidelines, awaiting a definitive pivot in global monetary policy that signals a true return to expansive liquidity. The prevailing higher-for-longer narrative, coupled with the relentless pursuit of genuinely productive growth, will continue to starve purely speculative assets of the oxygen they need to thrive. This isn't a temporary dip, it's a structural realignment, and those who recognize it will be positioned to navigate the turbulence far more effectively. We've covered a lot today, from Bitcoin's ongoing struggles and the pivotal role of Fed policy, to the surging strength of the dollar and the unwavering dominance of the AI trade that continues to pull capital. Understanding these intertwined forces, alongside key indicators like the Nasdaq's performance and the critical PCE data, is absolutely essential for anyone looking to protect and grow their capital in these uncertain times. The current market dynamics are not just noise. They are signals of a deeper, more fundamental shift in how capital is allocated globally, demanding a more discerning approach from investors. The next 90 days are going to be critical as these powerful trends either solidify their grip or begin to show significant cracks, setting the definitive stage for the rest of the year and potentially influencing asset classes for much longer. The informed decisions you make now, armed with this deeper understanding, could truly define your portfolio's trajectory through this transformative period. If you found this breakdown valuable, subscribe. We drop new finance videos every day. And watch our other videos to stay ahead of the market. Follow for more information.